Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. Sometimes it's hard to keep pace with all of the developments, not just here in India, but globally. We're talking to you today on a day when the US and China seemingly have seen their relationship thaw a little bit. There are signs that a deal might actually be in the offing, and at least there's a step down in the aggression that you've seen in the recent past. That can have a bearing on international markets, and in turn, it can have a bearing on your portfolio. How do you look at all of these moving parts and decide? Why not listen to what the Chief Investment Officer of Axis Mutual Fund has to say about that? Ashish Gupta joining me today to talk about what he's paying attention to when he's building his portfolio. Ashish, thanks so much for taking the time, and pleasure speaking with you. If you were to list out Absolute pleasure. If you were to list out the top 3 or top 5 things that you're paying attention to right now, at this moment, what would they be?
So I think the first really will be the earnings trajectory in India. I think while we talk a lot about global factors, but if you actually chart out the last 5 years, the Indian market performance, both outperformance, underperformance, have been very correlated with how the earnings trajectory has moved. So if you look at the period 2001 to 2024, the market did very well, primarily because the earnings growth was good, and most quarters earnings actually beat estimates. If I look at the last 5 quarters, you actually saw that earnings estimates were being brought down after each quarter, and the earnings growth that were running north of 20% actually dropped to single digits, right? Now, if I look ahead, I'm actually getting a lot more optimistic that from the December quarter, we actually will again start to see a double-digit earnings growth rate, and there is some potential for the earnings upgrade. And actually, the next financial year, FY27, we should come back to a 16-17% earnings growth. But I think the first factor to really focus on is the earnings growth trajectory. I think the second factor, of course, is really the global headwind. And it's been very surprising how resilient the global economy has been, despite all the challenges around tariffs that have been there since the beginning of this calendar year. And in most cases, it has been because most governments have followed loose fiscal policies. If you look at the US, now the monetary policy has also become easier despite the inflation challenges. So that has kind of helped the economies and the market rally on. The third big factor is, I think, this whole thematic investments around AI, because it is just one big pull factor for global capital today. Now we can debate how transformational that technology is and how long it will find its way into business application. But for now, really, it is sucking in most of the capital in the investment world. And I think the risk is that getting into a bubble territory.
Yeah, I mean, and that's a fair question to ask, wouldn't you say, Ashish, when you say that there are 3 companies now in the United States that have individually the market capitalization to rival India's entire market, which is absolutely incredible if you think about it. And we recently had a very prominent investor asking the question, would you rather invest in this company, or would you invest in the India growth story, or would you invest in India, right? So yes. I think the answer, I think, is pretty clear for a lot of people to have. But having said that, the search when you're building a portfolio, whether it's you yourself or whether it is the investor looking at stocks or whether it's the investor investing in mutual funds, is always to gravitate towards the fund manager or the fund that gives you alpha. My question to you is, has the search for alpha changed a little bit over the course of the last few years where you're seeing transformational policies and you know the direction where these policies are going, but you don't know when the impact of that will take place. If you name a few, you're talking about the income tax cuts or the reform there, you're talking about GST 2.0, you're talking about various measures to indigenize manufacturing in India, but we're yet to see impact on the ground, Ashish.
Sure. So I would actually say that there are transformational policies. And actually, from a stock market point of view, it becomes important to try to get to these themes earlier and actually be slightly predictive about what direction policies are going to take, right? So another example I can give is what's happened on the monetary and liquidity policy in India since January this year. So all of last year, last calendar year, you had RBI tightening. And since January this year, liquidity has been infused. You have had rate cuts come in, but you could see the direction it was likely to take because inflation was coming down, and all of us started gravitating more towards financial from the fourth quarter of last calendar year. Right, and you have seen the outperformance of the financial industry. I think I would say many of the policies that have been laid out by the government. You spoke about the GST rate cuts. The benefits of that has been visible. So if you look at festive demand of consumer durables. This year has been up nearly 30-35% compared to last year. And the effect of that is visible in multitude of companies today. So I think in this search for alpha, certainly government policies are something that we need to take a cue of. And to the extent we can try to predict the direction of policy, it really adds to the alpha that you can create.
You know, I have an added question to that, because if you're seeking alpha, it's of course trying to beat the market on the upside, but it's also protecting capital on the downside. So you need to be able to defend your portfolio when the chips are down. Ashish, we've seen cycles gets crunched quite dramatically, right? And you've seen significant volatility. Even if you look at the broader markets at the start of the year, you had 2 months where you had a 20% drawdown, and the next couple of months you saw the rebound, and it caught a lot of people off guard. They weren't anticipating that it would rebound so quickly. Is this a factor of money pouring into the system, despite the fact that you have foreign institutional outflows?
So I think there are several factors. Some are technical, like money coming in or too much liquidity on the sidelines coming in. There could be other factors which you spoke about. For example, that the government policy changed and you had income tax rate cuts and GST rate cuts. So both kind of added to that turnaround. But I think your earlier statement certainly holds true, that cycles are getting crunched. And I was looking at some data just yesterday. It was quite interesting that between September 24 to April 25, the Nifty corrected by about 16%. And then from April to July, it actually bounced back about 16%. Right, so so I think you do kind of are getting cycles which are lasting only a few months, but that's where the difference between alpha and beta comes, right? So it's not just a rising market where you need to have a high beta portfolio which does well when the market is trending up, but if you are actually trying to look at companies that are going to be able to beat estimates and be able to deliver better earnings growth than peers, then I think you will see that do well in kind of both these markets. So I think it goes back to your first question. You are seeking alpha, not beta.
Okay, so Ashish, I do want to understand on the portfolio strategy and getting into a balanced advantage fund, because this is something that I think gives my viewers a sense of where you're apportioning your portfolio in terms of equity versus fixed income. That And then very quickly, what's the strategy on the flexi cap fund?
Sure. So, Alex, on the balanced advantage fund today, our equity allocation is getting close to 60%. Early on in the year, we were actually below 50%. So equity allocation has gone up, but it is lower than the 74-75% levels we were running at beginning of last year. Because despite the earnings recovery, I believe that given the amount of supply that we are seeing from IPOs and stake sales in companies, the returns will be more moderate compared to what we saw last year.
And on the flexi cap fund, what are the major themes that you're playing right now?
So I think there are 3-4 themes that are kind of central to our stock selection today, both across flexi cap as well as other strategies. One of them actually is driven by government initiatives around indigenization, which is specialty manufacturing, EMS plays. Another area that is helping here is the quest for indigenization, where defense also kind of comes up with attractive opportunities. We are also increasingly seeing tech-first businesses gaining traction and domination in their respective segments. For example, companies which are in insurance distribution or quick commerce. So they are doing quite well. We are also seeing the benefit of wealth creation, higher income spends across many sectors. So companies that are delivering products or services on the premiumization plank are doing better than the peers. Also companies in segments like real estate or capital markets benefiting from higher income spending.
Okay. A couple of very quick last questions, Ashish. One, do you see enough value being left on the table in these IPOs that are coming up recently? If you were to say out of 10, how many look attractive to you?
I would say 2 to 3.
That's it. Okay. Okay, so that kind of answers my question. The last is so that my viewer can benchmark their expectations for the next year. Things are improving, you say, but then are we talking about double-digit earnings growth, and therefore is there potential for a reasonable what is long-period average equity returns over the next 1 year?
Yes, I think so. I think given the fact that we have had a period of consolidation and you have seen some degree of valuation moderation at double-digit earnings, and therefore returns will not be unrealistic.
Absolutely. Ashish, thanks so much for taking the time. Pleasure speaking with you as always, and look forward to the next one.